All right, in this session, we'll continue our discussion of managing price risk. Before we get into the third alternative, so we've talked two alternatives. One is the traditional approach using correlation as a risk mitigation tool. So you want assets with the low correlations to offset the risk of other assets. So stocks and bonds are negatively correlated, at least recently. And we talked about the issue with that is that correlations are very unstable over time, so they're very unreliable. Plus, correlations tend to reflect what's going on in the overall environment. So we said, okay, well, maybe diversification doesn't work as well there. So then we did the approach that we saw with Bridgewater and with the CFA presentation of looking at the environment and trying to manage not correlation, but manage the environments, make sure whatever environment comes up, we have some gold, we have some commodities, we have some treasuries, we have some corporates, we have some stocks, U.S. stocks, non-U.S. stocks. We have a diversification. So whether it's inflation, high inflation, low inflation, high growth, low growth, we have an asset that truly is diversifying versus the other assets. So those are two approaches. The third approach is my approach, which is the insurance approach. And so to get into that, let's talk about value at risk. Value at risk is our measure of risk. Correlation was our mitigation of risk. Value at risk, or VAR, is used extensively in the financial services industry to measure price risk, as you're probably seeing over and over again in your paper one. But there are people who do not like it. There are people who actually, we'll talk about Nassim Taleb and a few others later in the semester, who just think it causes more harm than good. One view I got was from a managed futures manager, a hedge fund manager. He presented to me, and I thought it was very interesting. I do like managed futures a lot. You might look that up as a hedge fund strategy. It's a very interesting strategy. It's a trend following strategy that did actually quite well in 2008. So it's an interesting strategy. And he presented his hedge fund, and at the end of the presentation, I asked him, why didn't you show us your value at risk? Every hedge fund I've ever seen, one of the first things they do is show the value at risk. And he somewhat rolled his eyes at me. It's not that I'm a big fan of value at risk. I think it has some weaknesses, but I was just curious. And this is what he said, and I did get his permission to put this in my class, but he says, I don't like VAR. Uncertainty and risk is like a cliff everyone stays away from. VAR is like building a fence along the edge of the cliff. Now, with that fence, with VAR, everyone feels comfortable leaning against the fence until all the added weight causes the fence to collapse. And that's essentially was his commentary on 2008, why 2008 was so bad, is that firms were doing something thinking they were managing risk, where what they were actually doing because of value at risk, they were doing the exact same thing everyone else was doing. And so when it all collapsed, when the fence came toppling down, the disaster was far greater than anyone could imagine because there were so many people trying to sell the exact same assets. So VAR ignores how people are all doing the same thing. And so this ties back to our liquidity risk. When people are all doing the same thing, but they all think they're safe because they have this risk measure that says everything's okay, and everything is okay until something goes wrong and everyone has to sell at the same time, then you get this incredible liquidity crisis. And the stock prices, bond prices, asset prices just fall a whole lot more than anyone could have imagined. Now, let me show you my view before we get into use of options. So value risk tells us to pick a risk tolerance, 1%, 0.1%, whatever. And once you pick that risk tolerance, then calculate your value at risk. And essentially what you're saying is, if I have a risk tolerance of 1%, my value at risk is $1 million. I'm going to assume $1 million is my worst case scenario because anything that happens less than 1% of the time, I just don't care about. Well, I don't like a risk measure that says ignore those low probability events because those are actually the risk I'm most worried about. Especially now since I'm retired and living off my portfolio, I'm most concerned about those downside risks, those tail risks. So the question I ask is there a way we can cut off the tail of this risk? Is there a way we can make sure that I know exactly what my maximum loss is and I can't lose more than that. So a good example of this is insurance. The way we manage investment risk is very different than how we manage other risk. Almost everyone has homeowners insurance, but very few people buy insurance for their investments. Insurance for investments is usually options, and we're not going to get into detail with options. Hopefully you've seen them before. But the probability of fire destroying over half of your house is far lower than the risk of your portfolio dropping in half, as we're seeing right now in the stock market. The stock market was down as almost 30% from its high. That happens more frequently than 1/3 of a house getting burned down. So why do we buy homeowners insurance but we don't buy investment insurance? Part of it is the cost. The cost of the insurance for investments can be much, much higher than that for other risks because it is more likely to happen. But I really think part of it's just inertia. We just don't think about it. It's not the way financial planners are trained. They don't get compensated for managing risk. They get compensated, as we saw on the exam question from the first exam, they get compensated for trying to provide alpha. They almost ignore risk. And since they're not compensated for managing risk, it's just the inertia. That's just not the way the industry thinks. So when we think about insurance, the cost of insurance rises when the risk of fire increases. If there's a major fire, if you're in California, and there's a major fire a few miles from your house and you don't have homeowners insurance, and you call State Farm or you call Allstate and say, I need homeowners insurance, first of all, there's going to be a 30-day waiting period. But secondly, they're probably going to charge you a whole lot more because the risk of fire is so great. With investment risk, with options, I think it's the exact opposite. I actually think the price of insurance for investment risk is actually at its lowest when the risk is the highest. We measure the cost of options using the volatility index. The volatility index is the implied volatility priced into options, which means when investors think that risk is very high and markets are very volatile, they charge a whole lot more for options than when volatility is very low. But when volatility is low, when the volatility index is low, I usually think that's an indication of market complacency, when people are just not concerned about risk. And that's when I actually buy more options. When options are on sale, when they're cheap, I actually think first I'm getting a bargain on the options, but I'm also buying them when the risk is the highest. It's almost as if you call Allstate, there's a fire outside your house, and they're actually having a savings. They're actually having a deal for homeowners insurance. They give you home insurance for half the price, and you say, well, there's a fire outside my house, and they're like, oh, that doesn't bother us. We still have this deal going on. I do think that's the case with options. And that gets into my approach for managing risk for older investors. I'll let you read the blog on your own. What I want to do is look back at this PowerPoint we were looking at before and walk through this last section relating to this last approach, hedging with options. And so, oops, sorry, I'm going the wrong direction here. Let me try it again. So if you're not real familiar with options, you don't really need to know them for this class other than some basics. So if you can go to Investopedia or Wikipedia and get some sense. But essentially what an option is, it's the right to buy something. We call that a call option, or the right to sell something. We call that a put option. You buy put options when you're worried about the price of something falling. And in fact, auto insurance, homeowners insurance are essentially put options on the price of your car or the price of your house. So you essentially pay an option premium to the insurance company, and you have the right to sell your house to them at some price, usually the cash value or the replacement cost. And you would only execute that if your car got destroyed or your house got destroyed. Same thing with put options. If the S&P is trading at 3,000 and I buy a put option that has a strike price of 2,500, I have the right to sell the S&P 500 at 2,500. Well, if it's currently trading for 3,000, I'm not going to sell it. But the S&P falls to 2,000, I now have the right to sell it at 2,500. So if my stock portfolio falls as the market falls from 3,000 to 2,000 and I have this put option that allows me to sell the market at 2,500, then the most my portfolio will lose is that from 3,000 down to 2,500. And so essentially put options are a form of insurance. Some people even use the term portfolio insurance. We use options a lot at UTSA in our mutual funds, but the lawyers would not allow me to use the word insurance in our prospectus. So even though I wanted to call it insurance, because it really was, they just would not let us use that term, but it really is insurance. In fact, your auto insurance and homeowners insurance, they use the term premium, which is the same term we use for the cost of an option. It's a premium, the option premium. You probably have heard that term before. So for older investors, they invest in stocks, they invest in bonds. They think stocks will make about 7%, bonds will make 3.5%, maybe lower today. If they have 40% in stocks and 60% in bonds, their expected return is 4.9%. And the strategy I really think is an interesting one for older investors. I haven't perfected it yet. I keep experimenting with it. It's worked really, really well in this last crisis, but there's still some tweaking I need to do to it. But the way I view it is, what if instead, if an older person, someone who's near or in retirement, instead of putting 40% in stocks and 60% in bonds, what if instead they put 100% in stocks, which has an expected return of 7%? So that's 2.1% higher than what they were expecting when they had 40% in stocks and 6% in bonds. So essentially they have a hedge budget or a risk budget of 2.1%. They can spend 2.1% to protect their risk, and they'll still come out with the same expected return as with this 40-60. So is it possible to spend 2.1% of your expected return to hedge this portfolio such that you have the same expected return, but you could reduce your risk dramatically? So what could you do? Let's say you have 100% in the SPY. SPY is the U.S. stock market. So you have all your money in the U.S. stock market, and then you buy 1-year puts that are 10% out of the money, and you do it at a 100% hedge, which means when you buy these puts, if the S&P falls 10%, you'll lose 10%. But after it loses 10%, you can't lose anything more. So the most you can lose is 10%. But this put option is expensive. So what we're going to do is we're going to sell call options that are at the money. So if the market is at 3,000, then if the market goes above 3,000, 25% of your portfolio cannot make any money. So it's essentially like you have 75% in stocks and 25% in cash, and you're using that 25% in cash to help pay the costs of the put options. So we can compare these strategies. So what we have down here is the return on the stock market. Over here we have the return on your portfolio. The blue line is if you had all your money in stocks. When the stock market goes up, you make a lot of money. When the stock market comes down, you lose a lot of money. The red line is when you have 40% in stocks and 60% in bonds. What it does is it just changes the slope of your return. Now it depends on the correlation between stocks and bonds, so it could be a little bit different shape here. You don't really know what bonds are doing. Here I just assume bonds made your 3.5%. We saw in 2008 and even now, if those are corporate bonds, they're actually losing money too, so the red line would be even lower. The green line is 100% in the SPY, but with that hedge, using puts and calls. And there you can see on the upside, it has a much higher expected return than the 40%, 60%, 40% stocks, 6% bonds. But on the downside, the max you can lose is this line right here. Might be about, I don't know, 10 to 11%. I have a spreadsheet. I might later in the semester show you that spreadsheet. I'm going to see a little bit how our time goes with this new format that we're using. It's a spreadsheet you have access to. Unfortunately, it's tied to the Bloomberg machines. But if you get on the Bloomberg machines, you can put in your own strategy and see how it works. It changes over time. Right now, this strategy that I'm showing you would not work well because the volatility index is so high. This strategy would be extremely expensive to put in right now. So this is a strategy you want to put in place when markets are not worried about risk, when the volatility index is very low. So it's an interesting approach. I want to in the next, well, I think in the next session I will show you 2 of the Excel spreadsheets that I built related to options. I do want you to see them, even though they're tied to Bloomberg. I have one version of it that is actually uses values rather than tied to Bloomberg. Haven't updated in a few months, so it's going to look somewhat out of date today given what the market has done. But it give you some sense that there are other ways to think about risk. And this is one of my big complaints with the investment industry. The investment industry is so focused on alpha risk and pure risk, as we talked about on that essay question in exam 1. I really think if we could get the industry to change its focus to risk management, we could come up with far superior strategies for our clients. And so let me show you some of those. I'm not saying these are the perfect strategies, but just to get you some food for thought, and hopefully one of y'all will come up with the perfect strategy. Although we'll have to say there may not be a perfect strategy, because the strategy you want to use is probably going to change depending on what markets are doing. All right, so we'll do that the next session.